All right, welcome back to the Gray Report. I'm your host, Spencer Gray, and every single week on the Gray Report, we're looking at what's going on in the multifamily investing space from a macro lens all the way down to a micro lens. Here at Gray Capital, we buy and manage large kind of institutional class multifamily assets. We're based out of Indianapolis. We operate throughout the Midwest, but we are tracking the entire national multifamily market. So if you're an investor, you work in the industry, you found the perfect YouTube show and podcast for you. Make sure you subscribe to the Gray Capital YouTube channel, the Gray Report podcast, wherever you're listening. Thank you for being here today. We've got a great episode. Griffin Haddad is here once again, co-hosting, helping break down this just wild world we find ourselves in. We've got articles we want to talk about, reports, what's going on with the Strait of Hormuz. No one knows. We'll connect that back to multifamily once again. We have a Fed meeting that's going on today. And we have a new Fed chairman that may be confirmed here in the next day or two. We'll see with Kevin Warsh. We're going to talk a little bit more about Kevin Warsh and the impact on his nomination and his chairmanship on the Federal Reserve. It's way more material than I've heard most multifamily owners talk. There are so many different currents and flows moving in different directions that are going to shape multifamily over the next 5 or 10 years, whether they're demographic, macroeconomic, structural, fundamental, technical. We try to look at it, all of them, every single week. Stick around for the whole episode. Let's get into it. All right, back to the report. Griffin, how are we doing this week?
I'm doing awesome. I got a
wonderful.
It was kind of a sly comment from one of our coworkers as I was entering the podcast studio today in my nice day crew neck sweatshirt. Maybe it's not as formal and fit for a video podcast, but one of the favorite things about Gray Capital is the company culture that we have here, Spencer, is there are times to be looking your best and presentable, but there's also a willingness and an opportunity to come in and express ourselves and dress comfortably through our, office workspace clothing.
Yeah.
And this is one of my favorite hoodies, and I was put it on this morning knowing I was going to film the podcast. You might have seen it before, but I'm excited to be here. I couldn't decipher if it was a good comment or a bad comment, but the crew neck sweater is in the podcast studio. It is a nice day outside. It's springtime in Indiana. Gray Capital's firing on all cylinders. The macroeconomic factors, all things, investing, capital allocation still remains uncertain, a little shaky. So how are you doing in this environment?
I'm doing well. It's interesting that you said that. I'm just trying to figure out where we are. Also, I appreciate the comment on the culture. It's not something that it's expressly written anywhere, but I do think that we have a kind of dynamic and adaptive culture. Knowing when it's appropriate to put on the full suit, tie, get fully kitted out, suited up, ready to go for the occasion, but also equally as comfortable in some flip flops. And we may be on the beach or the boat, or who knows what's going on, or the golf.
You've been known to wear some hiking shoes into the office,
sure.
Maybe following a morning at the farm, or maybe you going to the farm later on that day. So
who knows?
It's a nice thing to be able to walk into work wearing maybe something that I want to wear, and maybe not something that somebody else is expecting me to wear.
Yeah.
So
we want it to be effective. Obviously, where you project a certain image depending on what you're doing and who you're meeting with, and
right.
We want that image to be appropriate for the job we want to get done. But we also don't want to sap your soul away from you and remove all of your creativity and identity and individuality. I don't think you can be as full of a person and colleague, employee, all of that. We want you to be your fullest, and to do that, you have to have a little bit of independence and autonomy.
Correct.
It's just enough.
Got enough of it right here. And the conversation starter here. Nice sweatshirt. Oh, great. What'd you get?
Love it. And you can find it on the Gray Report web store.
I can put a link on there.
One day.
Yeah.
Maybe. Probably not today. Eventually, we'll be doing stuff like that. But you mentioned it's hard to figure out kind of what to do, where the world's going. We were having a conversation just before we press play. I think you're having some conversations with some wealth advisors and wealth managers and saying, what are you telling people right now? What are you doing? And the Federal Reserve, who's they're meeting today. They're going to be making an announcement. The rates aren't moving anywhere. It's Jerome Powell's last meeting as Fed chair. We're going to talk about more about that later. They don't know. They don't know kind of hardly where we are, let alone where we're going. And the Strait of Hormuz, as of right this second, is still closed. The UAE has decided they're going to exit OPEC. And I think WTI and Brent is back in the triple digits, over $100, and but the stock market's been at all-time highs, and so it's hard to know where to go, where that safe haven is. Because even gold, which is like a safe haven, is so volatile. The price was driven up. Now it's come back down significantly from like 5,500, went down as low as 42, 43. But that seems almost like more speculative now. And if stocks crash, gold's probably going to crash a little bit with it as well. We've had all kinds of sovereign entities but going into gold. I think eventually that's good for real assets. Real estate has kind of been out of favor for the last couple of years, so that gets us wondering, like, well, maybe that's the next thing to be rotated into. And we're biased, for real estate and multifamily, and I have a lot of reasons why I think it makes a lot of sense right now, and it is a safe haven asset. But there's also reasons to be concerned about the trajectory of multifamily over the long period. Some of the stuff with what Kevin Warsh is saying related to reducing the balance sheet for mortgage-backed securities, in the long term is could impact cap rates into the future or not. How AI is going to impact deflation, or how the current market could see inflation and how that could push rents.
Right.
The fact that so many household formation is being driven by renters, not homeowners.
Exactly. Well, I think you had a LinkedIn post the other day about just the uncertainty in the global, I would just call it economic environment and condition. Yeah. And specifically here in the United States, there's all sorts of volatility, unpredictability, and whether it's equities, I think even real assets, we've seen quite a rise in valuation in gold, and kind of coming back down a little bit. You had a LinkedIn post that basically just said, hey, in all economic conditions and environments, people are going to need a place to live and to sleep. Housing will be essential for the remainder of history, regardless of how impactful AI is. People will always need a place to reside. They need a roof over their head. Why not invest in housing? Whether it's single family, whether it's large scale multifamily, doesn't matter what type of housing it is, you should invest into it. And in some of those discussions that I've had with these wealth managers, my simple ask is like, hey, what is your outward facing message to your clients that otherwise are consumed by their day jobs and don't have enough time, energy, or capacity to listen to the Gray Report, to dive into some of the macroeconomic factors, do the research, understand the causation of this volatility and uncertainty? What are you telling them where to put their money? So many of these wealth managers will roll out, whether it's an index fund in equities and let's just perform on average, or they'll throw some kind of wild and crazy risky, let's take out or let's leverage our existing, equity portfolio, basically create their own hedge fund.
It seems really risky, and they say, it's not risky at all, but it's very complicated. You could not do this on your own. You need me to do it.
Yeah, it seems like they're spinning this web that is somewhat of a barrier to entry for their clients to have an understanding of what's happening.
Yeah.
It's kind of their protective mechanism. And not that all wealth managers do this, but same thing in real estate. We have our barriers to entry with our vernacular and our terminology, and make it kind of difficult to understand. But at the principle of it all can be very simple, but I found that these wealth managers are giving me somewhat of these complicated responses as to what they're doing and where they're telling their clients to put their money. One, probably because it's changing on a day-to-day basis, because it seems like the world is happening so quickly in front of us. It's changing on a daily basis. But two, I think it's kind of a protective mechanism for them of like, okay, I'm going to tell this young man, sometimes I like to refer to myself as this kid, tell this kid where I'm putting money, but he's not going to understand it. It's going to make me seem really smart, and then the conversation will be over and we can go back to doing whatever we were doing. But very rarely do I hear anybody say we're going into real assets.
Yeah. Well, it's because oftentimes, they're platform that they're on, is somewhat limited into what type of real assets they can invest in. They can't necessarily, call a Gray Capital and say, hey, I want to get my clients in your next deal.
Yeah.
Some can and some do. But some will say, well, we prefer this hedge fund that we have a relationship with that has this structured income product that gives equity-like returns, and it goes through a couple different feeder funds and is then is levered, but it's de-risked, and it's really a series of different laddered option strategies, and therefore it's hedged. And we're like, what are
you actually investing in?
What are we doing? And it's the reason for all that is first the person to get confused, and to say, all right, I want you to handle it.
Yeah. I won't ask any questions, just manage my money.
I want you to manage my money because I don't want to spend the time understanding all of that.
Yeah.
And what was, it was kind of been proved over and over again is that, not that there isn't alpha here and there, but if you're looking at the public markets, if you go into an index fund, most likely you're going to be achieving pretty similar returns as most of those complex strategies. Now, again, if your goal is income, that's different from total return.
Yeah.
But even then, sometimes it's like, can you just tell me you're looking at municipal bond? You just tell me which municipal bonds you're looking at, or a laddered strategy, or
right.
Why make it so complicated? Again, the reason is it's so you get confused and that you need them, and it's also so they can charge a fee and it's a product to sell. And it's like, I've got this product that I want to push you to and my clients towards, and I've got several of these products that I have on the shelf, and you can choose any of these products. When you go to a wealth advisor, you think that they're like, I can get you in anything. And they say that they can, because it's like, yeah, well, you've got your Schwab account connected, and sure, I can buy a couple stocks and pick a couple stocks for you. But then they'll tell you all the reasons why you shouldn't do that. And, then you can do that on your own, which, yeah, you can. Exactly. That's the whole point. And they're like, we really need to be looking at these structured products that we have for you.
Right, the in-house.
And I'm sure, and some of them are great. Some of them do slightly outperform. Some of them underperform. But they're all kind of layered with some sort of fee. There's kind of a catch.
Correct. And the conversation usually will morph into, I'm involved with a private equity, real estate firm. We specialize in Midwest multifamily, and we're seeing what I like to think is outsized returns or risk-adjusted returns. And specifically, what we're looking at today at Gray Capital and kind of forward look into the next, let's just call it 90-day period of time, is some significant cash flow coming out of these real assets to almost to where we're talking about. It's got a risk profile of almost like buying a fixed income product, but it's got the equity kicker on the backside.
Yeah.
And so you start to kind of mention that to these guys, or these group of professionals that otherwise is interested in all of this complicated nature, and it almost sounds too boring for them and too straightforward. But I don't know how you get them to want to have an interest in this fixed income.
Well, because it's not a novel idea. They've heard of real estate before, and their mind goes to, well, how do I make it complicated? And it's like, well, what could I not do with REITs? What is this doing for me that a REIT can't do? And then you're like, well, the tax benefits, the actual equity ownership, except all the reasons. But then the reason isn't like, okay, yeah, this is a good fit for my clients or a client. They are thinking of like, well, okay, how does this fit on my platform? And, how can I incorporate this? And how is the reporting going to work from my end? And so it's not a question often of, is this a good fit for my clients? Is this a good investment? It's just structurally, how can I make this work with my own business, and how can I make money in my business? Which are reasonable questions for them to ask. They're in the business of wealth management. It's their business. They're not running a charity. So they've got to figure out how it to work in their business. But if you're a client and you're relying on those advisors to show you the best opportunities, it's the best opportunities that they can show you, or have the ability, or have taken effort to want to show you.
Right.
And I say all this. There are some incredible wealth managers, RIAs, advisors out there that have robust alternative platforms that are flexible. And so, not to paint with a broad brush, but we hear it so often. And again, it's rare. It's rarely that it's not a good deal. It's more of not worth their time necessarily to
have to figure out how our product fits in their business. Yeah.
That's okay.
I mean, we've had some, I think, great communications and meetings with, I would say, some of these large wealth management platforms that otherwise, the barriers to entry for a firm like Gray Capital or a sponsor manager like Gray Capital to have access to that platform, requires years of relationship building and due diligence on the consulting side to then plug us, Gray Capital, into their wealth management platform for all of these RAs and wealth managers to have access to. But the groups that we've talked to, they can no longer put their clients into products that are off platform. So those are the groups where, we're asking, well, what are you guys investing into? They always have some complex, very guarded barrier to entry product that they're offering that kind of differentiates them from your middle market or local RIA. And then you go to the local RIAs and they seem to have to work through a little bit less red tape, and maybe they can onboard our product onto their platform a little bit easier. So it's just those conversations are always interesting because I think they can see the value in what Gray Capital is offering versus the large platform wealth managers that either already have access to, like you said, REITs or private real estate allocations on their platform, that they simply don't want to have the conversation with Gray Capital.
What I've also found interesting, though, in addition to what you just said, is how when they do have some of these RIAs, wealth managers, have a real estate option. And I'm talking about big RIAs. Mm-hmm. And we'll have a conversation with them. We ask them what they've been doing for multifamily. It's often they've got one guy, one sponsor that the CEO has known for a decade or so, and they've just been doing deals with this one guy. And so it's not we went out to market, we found the best of the best and these different geographies. It's more our CEO is buddies with a guy who does real estate deals.
Yep.
And that's it. And I'm thinking of whether it's here in Indianapolis, whether it's up in Chicago, whether it's in New York. I'm thinking of some really some of the biggest RIAs in both of these markets. That's kind of their sourcing. Yeah. It's not we went around and found the best, interviewed the best. It was we were in the same frat down at at IU or wherever. Yeah. It's
the boys club.
It's who's in the club.
That's kind of it kind of goes against the it kind of does go against the fiduciary kind of responsibility of them to allocate their clients' money into the best product available. If you come and introduce yourself to this firm and they can obviously say no, but if they're not nepotism, because that's kind of that has some allegations to it, but investing alongside your buddies, there's no problem there. But if there's a better product with a more prudent, accessible, active, effective sponsor for your client's sake and for the growth of their wealth, you should always entertain that. But we've been told a few times by groups, some of these larger RIAs, that have told us that they're utilizing the CEO's buddy or a guy from college they ran into, that, hey, we're just not onboarding new sponsors currently. Yeah. Which is a little frustrating, but I can also understand it.
Yeah, but again, it's all good. Nobody, no one knows anything to Gray Capital.
Exactly.
And Gray, so it's just the reality of the business. And as you said, Griffin, these are, year-long relationships, decades. And we work with a lot of RIAs already. We would love to work with more, because the last 2 years, and we'll move on to some more multifamily stuff, but the one thing that's been concerning to me that I've watched is the pouring into private credit, because you're looking for yield, looking for income. So many of the clients, obviously, are baby boomers. They're looking for income, looking for cash flow. And real estate, admittedly, the cash flow has got pretty thin on most deals over the last couple of years. You used to be able to get, and this is why RIAs were doing multifamily a couple of years ago, hand over fist. You used to be able to get 8% cash on cash out of the gate. And this is when we had no inflation and rates were zero. So if you could get 8-9%, we were getting 10% cash on cash in a lot of deals. Year one out of the gate, with IO, we were doing bridge to HUD, and we'd get 10% for the first year. We'd put on a HUD 223F loan, we'd fix the rate for 35 years, and it would still cash flow 8 or 9%. All day, let's keep loading up on that 8% cash flow. But then when cash flow shrinks to a 4 or 5, 6, when 6 becomes good, it's not nearly as attractive, especially then when money market accounts, munis, and all other rates come up. So all of a sudden, like, you can get better yield on a lot of fixed income products than you can with real estate. And then we'd push back and say, well, you got to look at the total return on real estate.
Yeah.
Sure. That's true. But when you have the mindset of, I'm looking at this as a fixed income product, and my clients are using this for their income, and I can no longer rely on the income because it's just insufficient, or there's volatility. My buddy got capital called because he did some deal in Houston or wherever. It changes that narrative. But so what's concerned me is private credit has looked like the easy option. Sure. And people are saying it's like so little risk. It's like 12, 13, 14, 15%. Low risk, no brainer. There's no such thing as 15% and low risk. That doesn't not low risk.
Totally agree.
It just so, and we've looked at. I'm just on the real estate private credit side. We were trying to put together a preferred equity fund, which is essentially private credit. It's the same, it's real estate, but it's the same thing throughout the industry. There's a lot of just trash deals out there. There's a lot of trash businesses, and a lot of the businesses that were getting these loans from private credit providers were software businesses. And we all have been talking about how software businesses in general are under threat. The whole nature of their existence is being questioned. It's existential. And these are all businesses that were like, oh, they're all going to be $1 billion companies. And so them getting a loan at, they were all going to 10x. So like a 15% interest loan or whatever is like no big deal.
Yeah,
it wasn't
no
a big deal for them. They were going to go into their next fundraise, and they were going to pay all that back, and it was going to be fine.
Yeah.
They were just on that track.
Now they're seeing revenue just get totally sliced.
Revenue is getting sliced, but also like the fundraising is stopped and the valuations are being questioned. And so you've got all of this, private credit that's out there on these software businesses that have products that I personally, not being a developer, I can recreate in days. When they spent hundreds of thousands of dollars or millions of dollars with a team of software engineers and developers, a year or years developing these products. And it has nothing to do with them not having a good product, and does nothing to do with me having any scary, interesting abilities. It's just the tools exist now, and the economics have changed to where the value of their product is really, it's being questioned.
Yeah.
So all these RIAs have been dumping their clients' money into these private credit funds because they're like, hey, we're replacing what you were getting on real estate or wherever, and we're moving to private credit. It's great, 12, 13%. I know the manager. They're diversified. They're managing everything well. It's all fine until it's not.
Yeah.
So that's what concerns me.
We've got an article pulled up here I think we should look at, but it's the Arbor article that just basically says that the renters are now representing 80% of household growth. So when you take a look at, that private credit versus going back into real estate, there's the fundamentals are in place and they're improving. We've seen it through the data in the last, let's just call it 6 weeks, to where the storyline for multifamily to kind of ramp back up and become, attractive again. To us, it's already attractive, but to the retail LPs, potential family office, and wealth managers and RIAs, the fundamentals are in place. Yeah. We've got some very light tailwinds, but it seems like they're picking back up. And I think this headline here, the renters now representing 80% of household growth in the United States, that's a significant percentage, and it would be a strong enough driver into the long-term demand for rental housing across our nation. For me as a wealth manager, RIA, family office, institutional allocator, hardworking retail LP, to just pay attention and to start to look at multifamily housing, rental housing again in a very serious fashion, as opposed to that corporate credit or private credit. Because we're seeing, again, in the assets that we're underwriting and getting ready to put under contract, the cash flow kind of is back. If that's fair to say. And then we're also seeing some really incredible growth stories in some of the Midwestern markets we operate in. Just because of some of that, what we're calling it a renaissance, Midwestern Renaissance, with some of the manufacturing, the jobs, tech companies, manufacturing, all sorts of companies are either establishing a larger footprint in their existing markets here in the Midwest, or they're moving their headquarters and starting something brand new here in the Midwest. And it's bringing a lot of jobs. It's causing a significant demand for rental housing. And it's all happening right here in our backyards.
And we're slowing down construction
while
we have demand. Whereas, like, and you go back to the Sun Belt, where there's still plenty of demand, but they're like ramping up construction more. Continuing to build. And part of that is structurally in the Midwest based upon affordability and rent levels, and the rents aren't as high in the Midwest. Therefore, developers are looking at markets that which have higher rents. And so just structurally, it's more difficult to build in the Midwest. The land exists, the power exists, the water exists, the everything else is there. Just the rent levels are relatively low, which is the reason why people come here to live, is because things are relatively affordable, a little bit more balanced. But there's an energy I can feel in the Midwest, and Indianapolis and Columbus, and whether it's when I go away and for a little bit, whether I'm on vacation or whatever, I come back and just try to get a little bit of a different perspective. Or consuming the social media that I'll consume, and when I see these stories, I think most mentors are like this, where there's just more like kind of micro content, local content. But when you have people coming in like doing reviews of Indianapolis and other Midwestern markets from, I guess, a novel perspective.
Oh, it's awesome.
It's so interesting to hear their take. Like, I'm here in Indianapolis for a couple of days. Like, here's what I learned, and this is why I think it's the best city in like the country. And I'm like, what do you? It's probably not the best city in the country. I love it, but like,
I'm glad you had a good time here, though. It's awesome. There's a lot of that going on with the kind of surge of social media, and you were born here, you were raised here. Same as I, and on my weekends, I'm kind of tapped out on new novel things to do. But it is awesome when you have a young, fresh, novel perspective come into town, or somebody that maybe was born and raised here that's now moving back in their middle stages of life, and their eyes are like, holy smokes, look at all of the growth. And with that growth, whether it's jobs and employers and housing, also comes, restaurants and retail. And that's been part of the fun, was watching some of these new developments, whether it's, there's a place up in Westfield that's going in that has a very golf focus. I
saw that, where the West Fork whiskey is
it looks like an awesome development. It's going to be just absolutely flooded with families and young kids for eternity. But what a cool thing that's getting brought to Indianapolis. And we're always, maybe 1 to 2 years behind some of the trends, but that's fine, because at that point in time, I think we get to learn from the lessons or mistakes, or learn from the mistakes to generate lessons on what model works best.
Oh, well, it gets distilled down.
Right.
Because it works somewhere else, and they're like, we're going to try it out in Indianapolis. And this has been true of Indianapolis for decades. It's like the franchise tryout markets.
Those people like it.
If it's like kind of works in Middle America and Indianapolis, it'll work pretty much anywhere else. And there's a couple other markets that they use for, I think, I want to say like Omaha or maybe Kansas City. But you're exactly right. Trying out a couple markets, distill it down, see what works, and then we get kind of like the distilled down version.
Yeah, which I think is good. But yeah, there's so much growth here. If you haven't been to Indy or Columbus or Louisville or Fort Wayne or any of our markets here in the Midwest, it's just growth is the story kind of across all of them. Lebanon and Indianapolis is amazing.
Oh, it's incredible, the Eli Lilly and Meta and all the stuff going on up there. Just looking back at this Arbor piece, looking at some of these charts, we talk about population growth and job growth, and I think this is really kind of getting down to more like brass tacks and what matters. And that's renter-occupied housing units, and looking at the growth of how many renters there are in the United States. Because it's one thing to say how many people there are, and we can kind of derive demand, or need from the general population, but like it's more important like how many people are actually looking for apartments and rentals. And with the affordability challenges, with single-family homes being so expensive, more and more folks are renting, and this number, really is some evidence for some tailwinds for multifamily, especially as supply is coming down, which it is. We've got 46.1. This is based upon measured in millions, so 46.1 million renter occupied housing units. That's up from 45.2 million renter-occupied housing units back in 2024. And then, again, they don't have a 2026 chart yet because it's just partially through the year. In the growth rate, and again, this was like the big growth rate back in, looks like this is 2021, when things started getting expensive, a big, 4% growth rate, and we've had consistent growth every year. I guess in 2020, actually during the, when the pandemic happened and rates were absolutely zero, there was a decline of 3.5%, but it has been kind of growing every year since then.
The demand story across the nation, obviously real estate is hyper local, so the demand story across the nation has also been interesting to follow. When we've talked about it here all the time, and the markets on the coast and in the south, they've seen a little bit, more saturation in new supply. They also are seeing, some population growth that may support that, but the absorption in those markets is less and less than comparative to the Midwest. I love all of this data, and every time I see it, I would love to have it, be not bifurcated, but, segmented into, some more granular information, whether it's regional or if it's market by market. I'm sure that we could distill it down and get there. But it is really awesome to be able to look at that first graph that you showed, and there's never been a higher percentage of the U.S. population that is renting, whether it's by necessity or by choice. And so I think that if you're looking at a bucket to allocate your funds into that is genuinely has some tailwinds, the multifamily space or rental housing space, the demand is there, and it's going to be there for a long, long time. 46.1 million Americans are renting.
Yeah,
it's just kind of remarkable.
Here, can I tell you maybe a kind of a dark way to look at it, but it's
sure.
I don't know. Maybe it's not dark, but unfortunately, the divide, income inequality in the United States is not great.
Yeah.
And we want it to get better, and better as in, there's more opportunity for advancement and equality. We'll never get to, an equal society. Everyone's going to have the same thing. That doesn't make sense. That wouldn't probably be a good society, just naturally, obviously, right? There's competitions and difference between people. But it's not good for a society because it can just shake itself loose if you've got people up here and then you got people down here who don't have anything. The larger group that doesn't have as many resources starts getting upset a little bit.
Yeah.
And so, but we haven't really been moving in the right direction. And a world in which multifamily is really falling out of favor is in a world in which we've really started to solve this income inequality problem in the United States, and everyone's able to buy houses and kind of move out of renting, which would be a good thing for the United States for a lot of people. But I am an optimist in many ways, and I think that there's opportunities for people to rent and still build wealth. So I think renting or owning is more like a lifestyle choice. It doesn't necessarily have to be like a financial choice, and it shouldn't be a socioeconomic or it should be a lifestyle choice. It shouldn't be you're considered lower class or less than because you're renting.
Right.
It should just be no one cares really if you buy. Who cares if you are financing or leasing your car?
Yeah, who cares?
Who cares?
At this point in time in history, to rent housing is the more financially responsible thing to be doing, unless you have that lifestyle decision that you say, I want to have a yard or I want to have to worry about fixing my roof. So,
exactly.
Yeah.
And so I guess where I was getting at is again, I want things in the United States to get better for everybody. I would like for there to be some, a balance between inflation and deflation, and I don't want absolute deflation, but I don't want everyone's purchasing power to continue to be eroded and eroded, and through inflation, which is an invisible tax. But I also have seen the trajectory of where kind of government, society has been going for a long period of time, many decades. And it would take so much to reverse course of whatever course that we are on right now. And so if we assume that the trend continues and we don't find some socioeconomic, panacea, the demand for rental housing will continue to increase,
Right.
more and more and more, and that will benefit multifamily owners and operators. And that's irrespective of whether the people who are renting those apartments, what the financial decisions that they're making. But the reality is, when you're trying to figure out where should I allocate my capital, if I have capital I'm in the fortunate position, the blessed position to have capital to be able to allocate, and you're an accredited investor and you're trying to find where to place it, that makes sense, that's going to be around and relevant in the next couple of years. Apartments start making a lot of sense, especially if you don't need a 5x your money in a couple of years. If I want to get a good return that's solid and probably is going to produce some cash flow that's really tax efficient, it makes more sense now than it has in a long time, especially when you take into account the cyclical nature of all markets, especially real estate, and you believe that we're probably at or near the trough. And believe me, I'm telling you, we're probably at or near the trough, especially in terms of just kind of the fundamental rent growth and fundamentals and supply peaks and things like that.
Yeah.
In the economy, things are starting to kind of turn around, where we've seen a lot of resilience, unless this war turns us over into a brief technical recession, which is on the bingo card. But even that, again, people still need a place to live. The fundamentals still exist. It's just there's some disruption. But multifamily makes a lot of sense right now.
Right.
And it's even AI. AI is obviously changing the world. It's going to change everything. But picking the right horse at the right entry point and the right valuation is really difficult to do. I mean, if you're going to twist my arm and be like, if you had to pick one, I'd invest in an Anthropic if I even could. You probably can't. But OpenAI comes out with 5.5 on Friday. Gemini is going to come out with something. Amazon, or Meta, or DeepSeek, or Alibaba. All of these, who knows who the winner is going to be? Good luck picking your horse in that race.
Yeah.
Right. You could get the 100x, or you could get the 0. While we'll be over here in multifamily, 2 or 3xing and getting solid cash flow. And I think do both. Have a barbell portfolio where multifamily, where it fits in, is it's a diversifier and a de-risker, and it significantly can increase the kind of the Sharpe ratio of your portfolio. Yeah, kind of get you out in kind of the efficient frontier where you're getting strong returns, but maybe less exposure to risk, and you're uncorrelated in the market. I think a lot of that's going to come back, and people see multifamily not as a lottery ticket that's going to 3x over a couple of years, and they're going to see it as just a solid real asset that produces good income, has a balance between income and appreciation, and is a diversifier that's tax efficient, and it's this really unique place that sits in your portfolio when it's comprised of, call it 10 to 20% of one's overall portfolio. It can do some really incredible things.
Yeah, it's a stabilizer, a rebalancer. But it's also a solution for income and for growth at the same time, with some tax advantages. You mentioned it, so I'm going to ask.
Okay.
You had mentioned on the bingo card is the potential chance for a recession.
Yeah.
Looking at the charts here, 46.1 million renters in 2025. We anticipate that to grow into 2026 and beyond. Supply is coming down in multifamily. The potential bingo card recession. Give me the argument for Class A multifamily in regards to stabilized acquisitions. The last asset that Gray Capital purchased and brought into our portfolio was a new developed A-class asset. What seems to be kind of where our acquisitions lens is headed. And so I guess give me the argument or the pro Class A stabilized acquisition argument in a time of recession, and why Gray Capital is so bullish.
Yeah, a lot of times the kind of top of the market can weather an economic downturn better than the kind of the lower quartile of the population. So if you're your target demo, if you're in the kind of B and C class apartments, a lot of your typical value add or true workforce housing, those individuals may get hit harder. And so they may lose their jobs, their incomes may go down. As costs increase, we're looking at gasoline getting more expensive because of oil. That's going to impact kind of lower income folks more so than the higher income individuals. Now, a recession can add volatility across the spectrum,
Sure.
and it's all the kind of the nature of how the recession looks. Again, typically there's more turnover kind of in the middle income demographics, but again, white collar workers also can be disrupted. And with AI, you just never know. But when there is that recession in terms of Class A, you've got folks that may have we're going to buy a home. Maybe they're not going to buy that home. They're going to rent for a little bit longer. People are going to stay, and also, but typically the person that's living in an A-class community, like brand new construction, on average has a little bit more savings, can weather that storm a little bit better, so they're a little bit more insulated. But no one is completely insulated. We like to say multifamily is recession resilient, or resistant. It's not recession proof. Nothing's recession proof. Because you don't know what the recession is going to be. So I say all this compared to when we're looking at acquisitions, compared to some of the workforce housing. We've been looking at a lot of stuff. It seems like it's either really close to brand new or it's built in the 1980s. And the reason why we're looking at the 1980s stuff is, one, you can't build it for those your acquisition basis. So you're buying something, sub 200 a door, 150 a door, 160, 170 a door. It's you can't build it for anything close to that. There's some value in there. If you're at a sweet spot in the rents, you want to, when you look at it, you're okay, could you move your rents $100 or $200 by fixing the place up? The challenge is there isn't always the room to move the rents $100 and $200 right now, especially because some of the A-class properties are so competitive, and they're providing specials that even if there's a gap of $100, $200, people are reaching for the nicer community because it has all the amenities, has all the benefits, maybe a better location, it's newer, it's nicer, it's the next thing. And the concessions are all of a sudden making them pretty competitive because everyone on the B class units have been pushing the rents, and they're still trying to push the rents. And the new deliveries, especially if they've been in lease up, they're we're just trying to get leased up. And I don't care where you've pushed your rents to, I just know what I need to make. And all of a sudden that gap is really closer than it should be, and so people are preferring the nicer thing. Because why wouldn't you?
Right.
It's only someone who's really at the edge, and that's the nicer A-class unit. Absolutely is an option. Of course, you're going to lease. It's something you can technically afford.
That asset class, that asset type, packed full of value. So owner operator of that new delivery, luxury A-class, you have the opportunity to set the market in times of recession.
Yeah.
As long as you can price those units appropriately, the occupancy should always be there.
Yeah.
And then I think there's another aspect of our business that sometimes our LPs maybe don't understand, but the way that we finance our acquisitions with long-term fixed rate debt, we really don't have any interest rate risk in there. And so we know essentially what our break-even occupancy is at a certain average rent in a time of recession. Obviously, break-even occupancy is maybe not necessarily a massive concern because we do have the best value in the block. It's just the pricing of that value.
Yeah.
Where does that need to be in order, one, first and foremost, to cover that debt service? Second of all, can we start to generate some cash flow? So you'll see, in any of our acquisitions in the A-class, we've obviously have projected returns. Those would likely come down. But it seems like that A-class asset is, like you said, insulated from some of the recessionary downward pressure on rents. In order to achieve that occupancy. And so it just seems like
if you buy it right and if you finance it right.
Right. Those are the two check boxes, I guess.
Yeah.
Buy it right and finance it right. But so then there's, LPs that are looking at some of these value add deals, B class, maybe C plus, going into a potential bingo card recession, with the outcome of the conflict in Iraq. If you're looking to allocate into multifamily right now, I'm sure there's some great B class opportunities, and it's market by market, just depending on supply and demand, and what kind of new supply might be coming online this year, next year, et cetera. But if I was an allocator looking at the multifamily asset class, I've read plenty of articles where it just seems like the Class A assets are really going to be in command for the years to come as we kind of work through some of the uncertainty we're seeing in 25 and 26.
Yeah.
And then obviously, depending on how the conflict materializes or fizzles out, they will still kind of hold that command over the market.
I mean, we talk about this a lot, especially this deal we're working on right now should be under contract soon. If you're watching the Gray Report and you're signed up, graycapitalllc.com, you'll get notified. But what's great about it, it's such strong cash flow. There's a tax abatement that comes with it. And so, like, out of the gate, we're like 7.5% cash on cash. We're trending to 8.5% over the hold period. We'll be at 8% by year 2, so fully paying the pref. What that means is, and we're not underwriting like massive rent growth either. So what we can do is we can actually, if we needed to, like this isn't base case, but if we needed to, and if there's a recession, we could lower the rents at the property significantly, still be cash flowing, fine. We could be, okay, we'll bring the cash flow down to 6% cash on cash, which is still better than most multifamily deals.
Yep.
But we can fill the place up or we can bring our rents down to the B class unit by the street. And we can essentially cannibalize all of their traffic because no one will live there if they could live at our community for the same price. No one.
Put a lot of pressure on those operators.
It's been done to us.
Yeah,
it's not something it's not something that we're looking to do. We don't want to be in that situation, but you have the room to maneuver. You have the headroom, but on a skinny deal. So let's look at that 80s value add deal that we were talking about. Let's say you buy that. You have to pay up because that's the only way to win it. And in order to achieve the rents that make the returns look halfway good, you have to spend $7,500 to $12,000 per unit. So you're going to bring a lot of equity onto the deal that drives returns down lower. And none of the returns make sense unless you can achieve that $100 to $250 per month premium that very few operators are achieving right now. So and then at the end of the day, let's say that you execute the renovation flawlessly. You achieve the 200 rent bump on time, flawlessly. The cash on cash is still sub 8%.
Right.
It's 6-7%. And the IRR now might be 15 or 16. Few are getting to 17. And if none of that works, it's an 8, it's a 9, it's a 10. On the A class, there's no renovation risk.
Right.
The risk is, mismanagement, which is the same at the value add property.
Correct.
Except the dynamics are much different because it's a lot more complicated. It's an older product. It's harder to hire staff for. The turn costs at an A class versus, B class 80s product couldn't be more different. At the A class community, one, you've got better demographics. So they're not trashing the place. Not that they can't. We've seen that too.
We've seen it before.
But usually the turn costs are mostly pretty minimal. I'm dealing with a lot of carpets. It's all hard LVP, plank flooring, solid, quartz countertops.
Yeah.
The whole kit and caboodle that is easier to maintain. Again, it's easy to hire the right staff, and that can't be stressed enough. If you're have a nicer community in a better part of town, it's no surprise that it's easier to hire someone to work there than a place that's in the ghetto or wherever.
Yeah, right.
I don't know, somewhere you don't want to be.
Right.
Like, good luck. Like, your pool is going to be of a certain. It's going to look different.
It's going to look a little different. Yes.
You're going to look and play a little differently. So,
it seems like the last acquisition we had was a brand new developed A class in a great location in its market, and then the deals that we are continuing to pursue seem to have a very similar theme and concept to that new construction in a great advantageous location in a growing affluent market where rent to income ratios are lower than
way lower than
our typical that 30% target. So that shows that there is room for rents to move. And the most exciting thing, I think, in talking about that deal that we are nearing putting under contract, our underwriting assumes none of that forward-looking growth in regards to any kind of manufacturing or tech companies coming in as promised to set up shop and deliver jobs. That's just our base case doesn't include any of those companies coming in, setting up shop, bringing that demand to the market. And so I think just taking a look at the trends of AI, tech, how these companies coming to the Midwest and establishing quite large footprints and bringing a lot of jobs with them, the base case underwriting for this asset is exciting. Like you talked about, 8.5% cash on cash across the whole period. I'm excited to see how it performs because I think the market it's in is going to continue to grow, continue to flourish, and lead the United States in multifamily fundamentals.
Yeah, I agree. I mean, that's why a lot of folks that's why people are looking at it.
Yeah.
People are looking at the Midwest, but those markets, and we're talking about Columbus, Ohio right now.
We are.
Well, that's what we're talking about, right?
We are, yeah.
Yeah, we're talking about Columbus, Ohio. We can say that again. Like
Nice.
we're not under contract, so we can't like give all the deal details away. Griffin wants to talk more about it. We have this beautiful
Chomping at the bit.
We have beautiful investment deck. We have a live interactive AI powered deal room that's the first ever that's ever been launched of its kind in nature, certainly in this form, in the history of mankind.
Yeah.
They'll all have the opportunity to go and check that out. We've got videos we're going to be coming out with. We got business plans. We're all getting kind of queued up and wound up to press launch.
Yeah, it's an exciting time. The conversations have started with some of our larger anchor investors, just in trying to kind of float some interest, but also all of our existing limited partners in any previous Gray Capital deal have an account on our investor portal.
Yeah.
You can access that live deal room there. They will be the first ones to gain access to any deal materials. If you are not an existing Gray Capital investor, you can still access our investor portal through the graycapitalllc.com. Top right-hand corner, go sign up for our investor portal. You will still have access to that live deal room when it becomes accessible. You'll have access to it first. And I think the most exciting thing, too, is we're starting to queue LPs for meetings really at the back end of next week, leading into what I think would be the first week of May, to really begin to dive into the nitty-gritty and the details of this acquisition and investment opportunity.
Yeah. Yeah, there's a lot to look forward to, and this one actually is going to probably go pretty quick because it has so much. The cash flow is so strong, and its location is so attractive, and just it's a beautiful asset. It was well built, well developed, well designed, and where when you look at the returns, you would think that, especially the cash flow, that like you would not picture this type of asset, this quality of asset. To get that type of cash flow, and the trade off, and we're going to get into a little bit of the details on it. There's always a trade off. The IRR is a little bit lower. The way that we're underwriting in the given environment than some of our deals have been in the past. Part of that is driven by the abatement, taking the appropriate discount, because there's a tax abatement on the property, taking the discount and the abatement appropriately at our year of exit. So we don't want to overcount and overvalue the abatement when we sell it. And because of that, we're kind of discounting like the exit. But it's still a solid kind of mid-teens IRR, but the cash flow, the strong cash flow, it makes up for that. Rarely you're going to get best of both worlds. Really strong cash flow and also a crazy IRR. Not that they don't exist, but that's like the really risky deals. Like we must be missing something. But this is like the way it's supposed to work, except that it's like just the value is so high, which is why when we talk about it being like in the efficient frontier of and like having an asymmetric risk and return profile, because when you throw everything at it, and we've thrown everything at this deal, like literally human underwriting, human stress testing, AI stress testing in ways you can't even imagine, that we haven't even shared with everybody yet. Thousands of angles we've attacked this deal. And then when you strip it all out and everything happens that's just horrible, it's hard to lose all of your money. Anything's possible. You can still lose all your money in any investment. And I think in 86.7 of all simulations, which I think we've done over 6,000 simulations now in this deal, you get your pref full 8%, and I think like 86, 87% of all scenarios.
It's incredible.
Like extreme downside scenarios.
Yeah, it's incredible.
So again, there's risk in everything. Things can always go to zero. We don't want to deliver just an 8% return. But again, when it comes to where do I place my money, where do I go for income, and what's going to be relevant in 5 years or 7 years, I think look at multifamily and then this particular asset in this particular market. It's a great example of skating to the direction of the puck. We're meeting up with where the market's going to be without over speculating, because we can back out all our growth figures and it's still a good deal. It still cash flows well. But when we just look at, like, again, when we pull up this chart, and this is national numbers, and this is the actual completions. When we look at forecasts over the next couple of years, we see those deliveries coming down precipitously. Actually, I think that there's one on this Greystone piece that we haven't covered yet, but I can utilize their the graph. This is just under construction. I mean, you can see this wave, just declining materially. In the market, the submarket that we're looking at, I think under construction is down by 75%. The whole market's down by like 40%. And you're just at the precipice of all this job growth, and you're on the precipice of some tax benefits coming back to people this year, and tax refunds. So I think it's a really good setup. I think for a couple different parts of the economy, but especially for multifamily. The difference between multifamily and other investment asset classes is that multifamily hasn't really appreciated much. It's kind of been declined, has been flat for the last couple of years. But you look at other real assets, or any financial asset, it's really kind of popped up in value over the last 2 years. Yeah. So again, coming back to this, if you believe in cycles, which, if you're an investor, you should, again, can't time anything.
Yeah.
But it's going to be multifamily and real estate's time here in the next couple of years. And that's when we set up the investment to not be short term. Let's set up for a 7-year hold period. Things are going to turn during that 7 years. Now, we could be wrong about, I don't think 2026 is going to be the year. This whole year, forget it.
Yeah.
Okay?
Yep.
First quarter 2027, I don't know. Second or third quarter 2027, yeah, I think so.
Right.
That's when it starts to could be wrong, but if it's 2028, that's okay too.
Sure, absolutely. I think the approach that we take is that long-term hold, where we're not saying it was going to be a 3 to 4 year hold or a 3-year hold where you got to enter and exit pretty quickly. It sets up a long time horizon for our investors' capital and gives us an opportunity to season the asset, get it kind of restabilized under Gray Capital and Gray Residential, and then grow NOI and start to reap the benefits of that appreciation, but also forced appreciation with increase of NOI and generating revenue. Taking a look, just kind of at starts forecast, Midwest versus the rest of the nation, population growth as well. Seems like the Midwest has seen what I would think is a very advantageous cross-section of multifamily supply and population growth. Population growth is increasing while supply is seemingly coming down, similar to across the nation. But again, we mentioned at the start of the episode, it seems like the fundamentals are spring loading.
Yeah. And,
you mentioned maybe we're at the trough. That spring's getting ready to go. And like you said, maybe it's not 2026. Maybe it's not Q1 of 27. If it's in 28, it's in 28. But it just feels like the multifamily ship is sitting there waiting for this tailwind to really pick up and catch its sails.
Yeah.
That was a great metaphor.
Yeah. Well,
I've been using the newsletter. So
I try to inspire. We don't know. It's all about being in the market. We didn't know that things were going to pop off in 2021, in 2021 either.
Right.
It just happened to be in the market. Not going to be right every single time, but again, it kind of comes back to our core philosophy and our principles of just following the first and second rule of investing, which is not lose any money, and then the second rule of don't forget the first rule, and just preservation of principal and capital, and whether it's investing our own dollars, so we don't want to lose our own money, but also bigger driver for me is I don't want to lose anybody else's money. It's a really important, critical responsibility. That's a lot of weight that we're stewarding all of this capital.
Yeah.
And so I would rather be a little bit more patient and say let's set this up for a longer term project so we can maximize the chance of success, and that I can get you your money back and take it from $1 million and turn it into 2 to 2.5. But I want to certainly make sure that if you give me $1 million, I can at least get you the $1 million back.
Get it back to you.
If not a nice return on top of that.
Right.
I just don't want a world of where we're saying, whoops, we tried our best, but it didn't work out, and it's investing, and you're a big boy.
Yeah.
I mean, that's all true, but like, I don't want. That's not what I'm here to build. And that's not what you're here to do.
Yeah, correct. It's like we see it on the LP meetings all the time. You do have limited partners that are not receiving their originally invested capital back in full, and some of them are not receiving any of it. Yeah. And that's worst case scenario, but it is impacting the perspective of LPs. And I think the most kind of strongly worded way that I can phrase to other people that are potentially thinking about investing alongside Gray Capital is those two things I think that you mentioned. Is that first and foremost, capital preservation remains at the forefront of our business strategy, and it happens up front at acquisition, where we're buying it at the right price and it gets financed appropriately, mitigating any entry risk or any kind of interest rate risk at entry. And then, second off is that at Gray Capital, and the culture here is that we also are investing alongside our LPs at a significant percentage to align interest or farther align interest. And when you start to mention all of those things, it makes it seem not foolproof, but it's a very great way to be able to articulate the fact that, like, we're also in this with you. And our biggest fear, like you just mentioned, is the potential of realizing any kind of losses of initially invested capital. And in our deck, and we love to kind of chat about it, all of the things that we've done really well, and not losing a single dollar of LP capital is one of those. And you made a great dashboard recently about our pipeline, and really all of 2025 and in the first few months of 26, we were trying to point people away from our track record and more towards that pipeline of look at all the deals that we've passed on. Yeah. Look at all the deals that we didn't pursue any farther because of X, Y, and Z. And those are the deals that I think are really a great display of the acquisition discipline that we implement. Yeah. Because there could have been a few of those deals that we've gotten involved in that otherwise we would have been up a creek without a paddle. We would have maybe paid too much for. There were some operating headwinds that otherwise we weren't aware of, that became aware of in later stage of the deal, where there's other sponsors or people out there that are just jumping at the next deal to do the next deal. Yeah. So I always appreciated that take of like, look, you can check out our track record. We think it's pretty great, but let's talk about all the deals that we said no to or we passed on because it just didn't seem like the best place to steward and funnel our LP's capital.
Yeah. Yeah.
Long-winded answer there, or long-winded phrase there to just say, we're disciplined, conservative, and we've got an approach of capital preservation.
Yeah, and it's not that like we don't want to also make a lot of money and have really high returns. It's just I think it's the understanding of what a zero return can do to your overall returns, and the pursuit of like going more and taking more risk is the upside is attractive, but having like full understanding what the downside can do, what it means, kind of prevents us from kind of getting out too far on the risk curve, and really trying to see like how high of a return can we achieve while taking the least amount of risk. And again, risk equals return. So like we're almost asking an irrational question, but it's trying to find. But that's why the deal pipeline chart is the way it is. Is because we have to go through 140 deals to find the one that has the right risk and return balance. Yeah. That's why this deal in Columbus, Ohio, the only reason why we got it is because we bid on it when a war broke out. That's the only reason why we won it. Because we bid on literally the property the next door like weeks prior. And it's under contract right now for like, at a 5 cap or like 4.9 cap or something. And we said, nope, sorry. Yeah. Here's our price. And we were like, this is it. We thought it was a great asset. It was a great asset at the purchase price. Ended up going about $2 million more than what we wanted for. And the property right next door is newer, nicer, better demographics, and we're buying it at a 6 cap, 100 basis point difference. That's the difference between positive leverage and negative leverage. Just a few weeks' time. And now if best and final bidding was this week, probably wouldn't get the deal.
Different story. More players.
It's just literally that's the times when we get our best deals, and most of our deals is when it's literally like the competition or the market like looks zigs and we zag. And we grab it. We just kind of scalp one off real quick.
Right.
And then we go back to trying to, in the thick of it, trying to make deals work. And we're getting outbid. We're 15-20% below everybody else. And everyone's looking at us like, what are you guys doing? And then all of a sudden everyone gets confused one day. And we don't know where the market's going to go. We don't know what. And we're here, we're convicted in this plan and the long term. And we're going to go. And we're not going to let short-term fear get in our way of finding high-quality assets at good prices. And I think this upcoming deal is a great example of all of that, the totality of our strategy and our execution philosophy.
I would agree. Yeah, it's the threading the needle there on the timing and just kind of being in the right place at the right time. But the only reason that we're in that right place is because we stuck to our guns. We trusted the data that we've been following for years and years, and just have a high conviction in the Midwest multifamily fundamentals. We know what a great asset looks like. We know what a growing market looks like.
And we also know, I'm being driven by cash flow.
Right.
I'm looking at it and I'm like, we can produce that cash flow based upon certain assumptions, or not even major growth assumptions, just like kind of base case what we're buying.
Yeah.
To me, that's buying deep value, because we're actually buying it on its income and fundamentals. We're not buying it on a speculative basis.
Yeah.
But oftentimes you can do that, but you're buying something that doesn't have a brilliant growth prospect. It's in a bad market. There's not a lot of growth. And so you're just like, we're just going to buy it for the cash flow. But this is, again, this great balance of like the cash flow is right there. It exists today. You have the opportunity to grow it much more over time. And then it's like, we're not assuming a big exit, but then there's all this opportunity for a big exit.
Yeah.
And it can paint three different ways to get there.
The conversations that I've had thus far about this deal and the market itself, there's been, I think, one concern raised specifically about Gray Capital's entry into Columbus, Ohio. And, the conversation that I had basically shared some of the similarities between the Columbus market, the Indianapolis market. But I want to give you an opportunity to kind of address this, because I think there'll be other people out there that maybe share the similar concern or are just interested in your perspective. But this new asset, pending getting it under contract, would be essentially the beachhead for Gray Capital portfolio and footprint into the Columbus market. Give me some similarities between Columbus and Indy, and tell, I guess, me and our listeners why we are so bullish on Columbus and being there, and what the forward-looking plan is in Columbus.
Well, I guess I'll start with why we like Columbus. Some are for just kind of fundamental reasons. Some are for practical reasons. We believe in kind of investing in what we know. That's why we started in Indianapolis and in Indiana. And then we kind of tried to buy and manage within a distance that's easy to drive to and from within a day. So again, kind of call it 4 hours max. The furthest property we have from our Indianapolis headquarters is up outside of Lansing, Michigan. It's about a 4 hour drive. It's a trek. It's a short day up there, but we've done it many times. You drive up there, get there around. We get there at call it 9 or so, and spend the morning and the first couple hours of the afternoon, and then it's either you're coming back or you're staying the night. But it's doable. We can get up there in a day versus hopping on a plane or a couple planes to get somewhere. And in the Midwest, like we know the Midwest, like the people, how like Midwesterners like think and operate, and just like the not all the states obviously have different rules and regulations, but like they're more similar. Michigan, a little different from Indiana or Ohio. Everybody's got their nuances. But Columbus, being a state capital like Indianapolis, there's a lot of similarities there. There's a lot of similarities there's a lot of corporate headquarters in both Indianapolis and Columbus. Columbus has more corporate headquarters. Columbus, I'm comparing it to Indianapolis because, again, that's what we're kind of basing it off of. And
Yeah.
like Indianapolis is our kind of template that we're copying and pasting over to Columbus. Columbus has some additional growth drivers. Again, I mentioned more Fortune 500 headquarters.
Yeah.
They also have Ohio State that's in Columbus. Now, Indianapolis has like IU Indianapolis, but that's not the primary campus. IU Bloomington is. And so there's different drivers. There's some similarities, but they're different. The logistics are big in both, a little bit bigger in Indianapolis. There's some more, both have defense contractors, both have technology. Columbus obviously has the pending, massive Intel, semi-fab that they're going to be building there, which we're not underwriting ever happens.
Yeah.
That's just like the upside that we've tried to not bake into the model. But then coming back to it's this great growth market that has volume. And a challenge for Gray Capital is like we want to do a lot of deals, but there's only so many deals in Indianapolis and Indiana, especially when it comes to deals that like work for us. And so by adding Columbus, and we're also highly interested in the other growing markets in Ohio, but Columbus as like the beachhead in the primary management node. There's a lot of reasons to be there. There's enough scale. So I brought up management node. We have centralized operations. So we have like a team here in the office at Gray Capital that's answering inbound prospective residents, but also existing residents that relieve some of the burden from the on-site teams to not like be on the phone all the time, but they're there to interact with residents. We also don't need as high of payroll at all of our sites. We always still have people on site, but you don't necessarily need a team to handle like some of the inbound calls because we have a centralized team that's doing that across the whole portfolio. So there's a lot more efficient having a small team to doing a lot of properties versus a lot of people at each site. With not always things to do. And so, but also being able to share maintenance facilities teams to be able to surge and to deploy. There's a lot of turnover on the maintenance side of the business, unfortunately. And so we want to have like people in reserves. And if you have a larger concentration of properties in an area, it's easier to move people around. You can afford to have kind of floating crews if you have that scale. So what the plan is at Gray Capital is we're looking to build scale in Columbus. We want to add about 2,500 units over the next 5 years. It's going to be a lot of work to find the right opportunities. And when I say Columbus, again, kind of the Columbus MSA and kind of nearby, metros that can be connected to the hub of which is, or the node that is Columbus, and kind of branching off from there. But we've already started the hiring process. We have job descriptions out, and we're interviewing people for regional manager positions to oversee kind of that Columbus node in that region, as well as people in the facilities team, property management team. So we're ramping up the infrastructure here at Gray Capital and Gray Residential. We're not just saying we're going to buy a property in Columbus and we're going to manage it with just the people that we have. We could do that, but we're setting up the infrastructure, to essentially take what we've built here in Indianapolis and copy and paste it over to Columbus to have a second node of operations and management.
Yeah, which is exciting for the growth of Gray Capital and Gray Residential, but I think it's exciting when you talk about this new pending acquisition. It won't be necessarily out there on an operational island. It's only a 3-hour drive. But the goal is to the goal is to continue to build out that footprint, build out that node in Columbus and make it a very efficient managerial and operating platform or market for Gray Capital, for Gray Residential. And it's really exciting to be able to kind of get that first fish on the hook, per se, in a market that I know has been on the whiteboard in our Chief Investment Officer Jay's office for a long time.
Yeah.
So it's not a market that we just happened to jump into just on a whim. It's a market we've been tracking. We've, taken several tours over the years of different assets in Columbus and made different offers. But this is the one we finally got in-house, and it's the start of something that could be, very, very special for Gray Capital and Gray Residential and also LPs in the projects, just by creating some of that efficiency in Columbus, in between Cincinnati, Columbus, Dayton, and Indianapolis.
Exactly. Yeah, it's going to be a great couple of years, and looking forward to getting into the Columbus market and having staff there and having a second management node. It's going to be great, and you can be a part of it. Everyone can, if you're an accredited investor, according to the SEC.
Or a maintenance guy.
Or if you are a regional manager, I mean, if you're anyone in property management, operations, facilities, leasing, whatever, give us a call. We are hiring right now. If you know somebody, go find us on LinkedIn. Go to the Gray Capital, Gray Residential page on LinkedIn. If you go to grayres.com, there's actually a whole careers page. So grayres.com is actually the best place to probably go. But as Griffin said earlier, if you are at all interested in just taking a look at this deal and getting access, even if you're like, I can't invest right now, I just want to see what these guys are doing, go to graycapitalllc.com right now. You can create an account. It's free. Obviously, if you're going to invest, you got to enter some more information. But just to get an account, it's really easy. And that'll give you access to the portal and all like the deal documents, and also there'll be a link to that live interactive AI-powered deal room that again is the first of its kind, never seen by any human eyes before until now. Check it all out, and let us know what you think. We'd love to have a conversation with you. Schedule a meeting. It's all there.
We're scheduling meetings already. So send me an email, griffin@graycapitalllc.com. Send Blake an email, blake@graycapitalllc.com, or just click on the schedule a meeting button on our homepage. We'd love to just chat with you, discuss the deal, and when we can divulge the information and make the deal room publicly accessible, we're excited to do that.
Yeah. All right. Well, we promise not every single Gray Report episode is going to be a pitch for our upcoming deal, but you're going to hear about it a lot. So we'll probably hold a lot of it till the end of the episode. We'll still be dropping all of the important multifamily reports, research articles covering, again, commercial real estate, macro economy. But you're probably going to hear a lot about this upcoming deal because we like it so much. And but I think it's a great opportunity. Again, if you were interested in the deal process, we're going to be sharing. I'm going to be sharing every single week what's kind of going on. What we're doing. Sharing everything that I can, from the conversations that we're having, just the challenges, the hurdles, and there are challenges in every deal, whether it's putting the debt in place, whether it's doing the due diligence, whether it's raising all the capital to get the deal done. Right now we're in the process of negotiating the purchase and sale agreement with the seller. I can't get into a lot of those details. Maybe once we're under contract, we can. We can bring Jay in because there's like the more of these you do. We've done a lot of them now. You get better at each one of like what you can ask for, or what you probably shouldn't ask for. Yeah. And as technology changes, and we just know these we just know property management better. We know the systems, we know the technology. We know the levers. We know what to ask for, and you can just the firms that are just a little bit more old school versus the firms that are a little bit more progressive. It's all all good either way, but it's always interesting to see the differences. And we're asking for things that we know we're probably not going to get in some cases. Like we're asking for API access for their PMS system. They don't know how. Even if they could, they probably don't know how to get us that access.
Right. They're asking about what is that.
They're like, what is that? But that's all good. We do. There's, we just sometimes we find really efficient ways to do things, and but real estate is such an old school industry business, which is that's where the market inefficiencies take place, and that's where you can actually make some money, and that's why we like it. So it's been a good episode, Griffin.
Yeah, we didn't talk about any of the articles. We did talk about one.
We talked about one.
You brought up the second one, so
I brought up the second one, and we technically we did. I don't know what article I'm sharing right now. We did, all these advertisements. I can't even show a single article. We did mention that Jay Powell having the last FOMC meeting today. Kevin Warsh is likely to be confirmed, and we'll do a whole probably breakdown of what that could mean, because I teased at the beginning about, again, getting out of the real estate business and MBS, selling off all the MBS. I think makes a lot of sense from like what the Federal Reserve should do, like if you're going to have a Federal Reserve. But it could be challenging for multifamily But that's again where all of these different kind of streams are. Where's the null point, and what beats out? Is it the fundamentals? Is it the demographics? Is it MBS sales? We'll see. Stick around. Love to hear your thoughts on today's episode. And if you haven't subscribed to the Great Capital YouTube channel, this is your sign to do so immediately. Thank you. All right, we'll catch you on the next episode.